Yes, we're live. Good morning, everyone.
Hello,
I am
world.
Adam. That's Will, Market Chameleon with you.
And that's a disclaimer. Did you put the disclaimer up?
The disclaimer is up, man. Oh, I forgot
Remember, options can have unlimited risk.
In Spanish, we say sin límite.
Sin límite?
Sin límite.
Love that. I love that. Who would have ever thought a McBride could speak a second language?
Well, that's debatable, man.
You've broken all the mold.
My son, who speaks perfect Spanish, is like, "Daddy, please, you're hurting my ears. You're hurting my ears."
Do not speak. Let me translate for you when we go to McDonald's order our cheeseburgers. There's a wolf in the background.
No, that's that wolf in the cage. That's Bear and Puma, my two wild savage dogs, Bear and Puma. So what? That's another story. I was going to name my son Puma. Which
there is some interesting commentary coming out of the Trump administration. It's the first time. It's an announcement here first on Market Chameleon. If you've ever followed his Twitter feed, today he announced that it may not be appropriate for companies to report their earnings quarterly. We should start doing research into yearly reporting.
Ooh,
that would be interesting to the options market if that happened.
Whoa, would that make earnings season
once a year,
crazy?
Baby? Once a
year. Oh my God,
it would be the build up to that yearly event would be super interesting.
They should have them all. Everybody releases on the same day every year. All companies on December 22nd every year.
How soon the world forgets how interesting it was when there were no reporting standards.
Dude, that's a little bit insane, man. Wow. That's going to be like government regulated. Yeah, that's a good idea. Let's keep government more involved.
Well, whatever
they do turns to gold, man. Whatever the government does, that's just good living.
Everything's been set up around the quarterly reportings, and the analysts be able to get under the hood of the car. But management is saying that people are planning too much for the short term because of this. So who knows? But love the fact that El Presidente is getting in the mix.
Chiming in, man.
Chiming in. Guess how he's chiming in?
Tweeting.
What do you think he's using?
Tweeting. I was doing some tweeting last night watching the Jet game. You on following my Twitter feed?
Yeah, loved it. Loved your insight on the Jets. Well, I'm going to share the screen. Let's look at this Twitter.
Yeah, man.
I own that dog.
I told you to get rid of that thing. Nobody's using it, man. Except me. I'm on it now. You guys can all follow me, Adam A. McBride.
Adam A. McBride. That sounds like self-promotion.
You get it's all about self-promotion.
The four chameleons who actually turned us on this morning.
All right, so
me and your two wolves down there.
Okay, so Twitter is up. Looking at
that was up. Yes, that's up yesterday. It's got nothing going on this morning. Let's
refocuses on its core experiences. What are its core experiences?
The core experiences are the fact that President Trump uses the thing.
It's true, man. It's true. I can't believe you're long that stock, man. I mean, unless somebody, you're trying to catch a miracle.
Again, the same reason I bought Snap, which is still hurting me. I was a buyer, down in here.
Okay.
So why I didn't get out here? You tell me. That's when I should have.
Well, you never know. If
I'd been smart and looking at grabbing some extra yield on this product, I probably would have had the stock taken from me. And I wonder what. Let's look at the buy right search, which is if you're looking for extra yield, which I am always. You know what that means, brother? Looking for extra yield.
It means you are loaning the stock, right?
That could be one way. You could be loaning the stock, but that's not what I'm doing. I would be looking, if you buy right, so if you sell the calls against the stock you own, you will collect that premium if the call does not finish in the money above the price, the money right here. So did I flub that?
Dude, you can't be expected. You've been in this so long, you just know what the things are. You don't remember what the actual word of it is, man. That's when you know. That's when you know you're an expert. When you're like the thing, you're like, what thing? The goobly gloobly. You just know it as something, right? It's in your brain, but you've lost the technical word for it. That's when you know you're an expert at something.
The strike price is what I was searching for somewhere. Anyways, so Twitter, if you look, this is the front month. This is expiring today. As of yesterday, the premium was 0.9%. You go the next.
I believe in the profession we say spot 9. It was spot 9.
You could say that. So creative. The next expiration out, the at the money strike will yield you 2%, so on and so forth. That obviously if it closes above that, the money, the call will be taken from you, so you'll lose the stock. You'll have to deliver the stock, or you'll have to buy that call back and roll it into another month if you want to keep the stock. But so this is the extra yield you can get looking all the way out to January of 2020. You sell the at the money today, you can yield 21%. So 1/5 of the stock price.
How do you take the opposite of that trade?
You buy the at the money calls. You'd be buying the at the money calls.
It would seem to me like with all the risk in Twitter, to think that 17th of January 2020, you only give up a 21.6% premium. That seems to me like a relatively decent risk right there.
Well, we can look. So you're saying you want to get short the Twitter?
Yeah, I mean, I'll pay somebody 20% to see if there's going to get some crazy volatility. I mean, that Twitter could go to $1, or it could go to $150.
Well, you're
depending on, if somebody looks to buy out Twitter and wants to add it to their portfolio because they realize that Twitter is the water cooler of America and the world, and they want to be in charge of that water cooler, even though that water cooler might not make any money. Twitter now at 32.83 could go 32.83. Sorry, could go to $183. And
so you would. I mean, I'm confused now. So you're looking at.
I want to pay the 21% to be able to control that.
Well, why you'd pay a fifth? You'd rather pay a fifth of the stock value rather than own the stock and be susceptible to going to zero.
Because it could go. I mean, it could also go to $1, right? And it could very well be worthless too. It could go either way. I mean, it really, for me, it depends on when you're talking about Twitter specifically. It depends on another company. It doesn't actually depend on Twitter. It depends if another company's interested in Twitter.
That's a good point. I would like, if I was going to play your side, let's go to the option. I mean, if you look, I've got the implied vol up, and the IV that is at a real low point in its. I mean, all these up cycles are around earnings.
Yep.
So it's just after earnings. So if you were looking to do something, you'd want to look. So when we get that yield, we look it's taking it from where the closest strike to the at the money, which yesterday was 32.81, the spot price.
Right.
So, I mean, other things you could do. So that's where you look to buy. So that's where you would have the most. You would have, premium to lose, and you'd be paying, 20%. But if you look at where were we looking? January 2020. So you'd be paying, they were looking at this straddle probably when they were pricing it. So you could go, and the premium is showing that it's pricing that, people are taking positions in, if you go here, you can look at the open interest and see where the positions are being built. This is open interest. So the highest open interest is kind of what you're saying. People are taking shots, basically.
Sure.
Buying that line at 65, paying, $1.50. So that's how they're playing, what you're talking about.
Yep. And
again, both our points being that you you do the analysis, right, and see where you want to put it. I mean, there are lots. I mean, I'm a little more bullish of stock. If I was thinking about playing the upside, I would look at the upside calls, the most, maybe look at the most active versus selling a put and trying to finance that trade via the put.
Right.
So you could sell the 27 put, buy something up here, collect a credit, meaning you're going to sell something for more money here than it costs to buy up here. So it's actually going to pay you to hold it. The risk being, obviously, the stock trades below this. If I was looking at the 27 layout, the most active, you would own the stock where?
27.
Yep, at 27. So you'd have to be willing to take delivery out in 2020 to 20. But this has kind of moved me in a different direction than I was going to look for yield. Is it too late to look for yield?
Go ahead, man. Break it down for us.
Break it down.
Look for some yield, man.
So I've been trying to build a portfolio of yielding stocks and assets. I have people love rental properties, right? Because they give them a yield every month in that rent payment. So another way to do it is through the ownership of either REITs, which are the actual tradable instruments on the exchanges actually hold different types of real estate, or stocks that yield in their dividend. But so there's a dividend calendar where you can kind of piece through. This is available to everyone, but the premium has some great. Why not just go to best dividends, right? You click on best dividends. You see that? Hello?
Yes, I got it, man. Can you hear me?
I can hear you. I just want to make sure down in Costa Rica, you too can find yield.
Well, that's pretty clear. It says best dividends. I mean, that pretty much tells you even the rookies like me know what that means.
Well, and obviously the best. This is the Aristocats, which they're a bunch of ETFs that recreate this, but these are all the best yielding stocks in the marketplace. ExxonMobil, AT&T. I mean, we all know these stocks. We can organize it by yield. The best being AT&T right now, 6%. Didn't Apple Computer come out of the AT&T lab, or was that out of the Xerox lab? I mean, it's amazing.
No, it's the mouse that was Xerox, man. The mouse.
ExxonMobil. I mean,
yeah. All right. So if you want to take a position in one of these and get your yield, tell us what your risk is.
Well, let's just look at T.
Mm-hmm.
AT&T. Just looking down. I mean, you see the short interest here.
Yep.
This is what the street is short. So there's not a big short.
What would be considered? What would you think is a big short?
I would say anything over 5% short, I would start to worry about.
Okay.
The dividend yield is 6%, and you could we could also look at again the buy right search and put in T. You can always, if you go out, you can actually to 2020, like your sale, you can get another 9%, or which I would more likely do is move up to a closer strike, and it looks like you can get almost 1% just going out. What's that? Like 15 days? Seems better doing that, right?
Well, less risk. I mean, you can get in and out. All right. I mean, this is what you do. You trade small, trade often, right? That's your strategy.
I think that's what everyone should be doing, their research, trading small amounts of their portfolio, in every trade. Never put too much risk into one trade.
Yep.
And but I mean, I'm not saying if you're looking for yield and you have the dividend stock, that you go out and do the buy right as well. But it's just another way. If you're looking for yield and going to be into the market, it's another way to add to that yield. It would go from, you could add to that 6% a year.
Yeah.
By buy right in this stock. There's nothing you say, well, what's the risk? I mean, the risk is the stock. There are two risks. The stock, if you own it, the stock goes down, right?
Right.
There's a risk to them cutting the yield. There's all these unknown risks, but you can look at the volatility and see where the vol is and see what the market's pricing for risk. And right now they're pricing volatility is very low. So there's, it's sometime after earnings, I'm sure, which is where the volatility spiked a little bit. The vol's now back in, but there's no magic formula that says there's no risk in AT&T. It's just you're getting some other benefits to own in AT&T.
Okay, so wait, hold on. I just want one more final question while we wrap this up. Imagine this as a portfolio. I have a large portfolio. I have taken a lot of these positions, right? In order to get the dividend. How do I protect my global portfolio? Is there a way to hedge the entire portfolio in that sort of way if there were suddenly a spike in volatility? And
the best, I believe, and I think the market does, is the SPY.
Yep.
Using the puts in the SPY to protect your downside is a good way.
Nice.
Using those SPY puts, and again, the volatility on a relative level is still very low. So you can always, and again, you're buying insurance against your portfolio, right?
There you go.
So
there you go. Good tips today, man. Thanks, dude.
Hey, thanks for having me on the Market Chameleon.
All right, guys. Have a great day.
Bye.
Safe trading.